Beyond Bitcoin, unveiling the potential of Ethereum ETFs. Hey everyone, and welcome back to Chat ETF. Today, we're diving deep into the world of Ethereum ETFs. Confused about what that even means? Don't worry, we've got you covered. Think of them like a bridge between the traditional stock market and the exciting world of Ethereum, a powerful blockchain platform powering things like DeFi and NFTs. In this video, we'll break down everything you need to know about Ethereum ETFs, what they are, how they work, and whether they might be a good fit for your investment journey. So, buckle up and get ready to unlock the potential of Ethereum without the complexities of directly owning it. Stay tuned. Don't forget to like and subscribe for more insightful ETF content. Question 1. What is Ethereum, and how does it differ from Bitcoin? While both Ethereum, ETH, and Bitcoin, BTC, are prominent cryptocurrencies, they serve distinct purposes and operate under different functionalities. Ethereum Decentralized platform primarily functions as a decentralized platform that enables developers to build and deploy smart contracts and decentralized applications, dApps. These applications can range from financial services, DeFi, to supply chain management and more. Programmable. Unlike Bitcoin, Ethereum features a Turing-complete virtual machine, allowing developers to write complex code and create diverse applications on its blockchain. Proof of stake, POS. Currently, Ethereum is transitioning from a proof of work, POW, consensus mechanism to a proof of stake, POS, model. This is expected to significantly reduce the energy consumption compared to the energy-intensive POW system used by Bitcoin. Ether, ETH, as the token, Ether, ETH, serves as the native cryptocurrency of the Ethereum platform. It is used to pay for transaction fees and computational resources required to execute smart contracts and dApps. Bitcoin Digital currency primarily functions as a digital currency intended for peer-to-peer electronic cash transactions. Limited supply. Bitcoin has a limited supply of 21 million coins capped by its code, making it scarce and potentially appealing as a store of value. Proof of work, POW. Currently, Bitcoin operates on a proof of work, POW, consensus mechanism, which involves miners competing to solve complex cryptographic puzzles to validate transactions and secure the network. This process comes at a significant energy cost. Bitcoin, BTC, as the token, Bitcoin, BTC, is the native cryptocurrency of the Bitcoin network. It is primarily used for making and receiving payments on the network. Question 2. What are Ethereum ETFs? Building upon the understanding of Ethereum, let's now delve into Ethereum ETFs, exchange-traded funds. An Ethereum ETF is an investment vehicle that tracks the price of Ethereum, ETH, the native token of the Ethereum blockchain. Similar to traditional ETFs that track stocks or bonds, an ETH ETF allows investors to gain exposure to the price movements of ETH without directly owning the underlying cryptocurrency. Here's a breakdown of the key aspects of ETH ETFs. Composition. ETH ETFs hold underlying assets primarily consisting of Ethereum, ETH, tokens. Function. They aim to track the price of ETH, providing a way for investors to participate in the potential growth of ETH, without the complexities of managing the digital asset directly. Trading. ETH ETFs are traded on regulated stock exchanges, offering greater accessibility and convenience compared to purchasing ETH on cryptocurrency exchanges. Question 3. How do ETH ETFs work? The inner workings of ETH ETFs involve a collaboration between several entities. 1. Fund creation. Asset manager spearheads the creation of the ETF by raising capital from investors through an initial public offering, IPO, or subsequent share issuances. 2. Underlying assets. Investment. The raised capital is used to purchase Ethereum ETH tokens, which become the primary holding of the ETF. Custody. These ETH tokens are then securely stored with a qualified custodian specializing in safeguarding digital assets. 3. Share creation and trading. Share units. The ETF subsequently issues shares representing ownership in the underlying pool of ETH held by the custodian. Exchange listing. These shares are listed on regulated stock exchanges, enabling investors to buy and sell them like any other stock. Here's a step-by-step breakdown of the process. 1. Investors invest capital in the ETH ETF. 2. The fund manager uses the capital to buy ETH tokens. 3. The ETH tokens are deposited and secured with a qualified custodian. 4. The ETF issues shares representing ownership in the underlying ETH. 5. Investors can buy and sell these shares on the stock exchange. Key points to remember. Unlike physical ETH ETFs that directly hold ETH, not yet widely available, most currently available ETH ETFs are futures-based and utilize futures contracts to gain exposure to ETH. This introduces additional complexities compared to physically holding the asset. The price of the ETF shares fluctuates based on the supply and demand for the shares on the exchange, as well as the underlying price of ETH. By understanding these mechanisms, investors gain a clearer picture of how ETH ETFs function and the different entities involved in their operation. Question 4. What are the advantages of investing in Ethereum ETFs compared to directly buying Ethereum? Investing in Ethereum ETFs offers several advantages over directly buying Ethereum ETH tokens, particularly for investors seeking a more accessible and potentially less complex approach. 1. Accessibility. Traditional trading platform. ETH ETFs trade on regulated stock exchanges, making them readily accessible to a broader range of investors who may not be comfortable navigating cryptocurrency exchanges. This eliminates the need to establish accounts on cryptocurrency exchanges, which can involve additional steps and verification processes. Familiar investment vehicle. For investors accustomed to traditional equities, ETH ETFs offer a familiar investment vehicle. They can be bought and sold through existing brokerage accounts, potentially simplifying the investment process and reducing the learning curve compared to directly acquiring cryptocurrencies. 2. Regulation. Regulatory oversight. Unlike the largely unregulated cryptocurrency market, ETFs are subject to regulatory oversight by financial authorities. This provides a layer of protection for investors, as these ETFs are bound by specific rules and regulations concerning transparency, disclosure, and investor protection. 3. Diversification. Portfolio diversification, including an ETF in a portfolio, can be a valuable tool to achieve diversification. This allows investors to gain exposure to the potential growth prospects of the cryptocurrency market, without placing all their bets on a single asset like ETH. Diversification can help mitigate risk by reducing the overall portfolio's dependence on the performance of a single asset class. 4. Convenience. Simplified custody. Owning an ETF eliminates the complexities and potential security risks associated with managing private keys and securing your digital assets directly. This responsibility is borne by the qualified custodian employed by the ETF, simplifying the investment process and reducing the potential for user errors or security breaches. 5. Liquidity. Enhanced liquidity. ETFs generally offer higher liquidity compared to directly owning ETH. This means that investors can more easily buy and sell shares at the desired price, which can be particularly advantageous for larger investment amounts or situations where quick exits might be necessary. Question 5. What are the risks associated with Ethereum ETFs? Investing in ETFs, like any investment, carries inherent risks that investors should carefully consider before committing their capital. Here's a breakdown of some key potential drawbacks associated with ETFs. 1. Fees. Expense ratios. Compared to directly owning ETH, investors in ETFs incur additional expense ratios levied by the fund manager. These fees cover the costs associated with managing the ETF, including custody fees, administrative expenses, and potential performance fees in some cases. Higher expense ratios can erode long-term returns, so it's crucial to compare expense ratios across different ETFs before investing. Trading commissions. Investors may also incur additional trading commissions when buying and selling shares of the ETF through their brokerage accounts. These fees can further contribute to the overall cost of investing in ETFs. 2. Tracking error. Imperfect price tracking. While aiming to track the price of ETFs may experience slight deviations in performance due to factors like expense ratios. As mentioned earlier, the fees associated with managing the ETF slightly eat into the returns, leading to a potential tracking error compared to the underlying ETH price. Underlying investment strategy. Different ETFs might utilize various strategies to gain exposure to ETH. These strategies can introduce additional complexities and potentially lead to tracking errors. For example, futures-based ETFs might experience discrepancies due to the inherent differences between futures contracts and the underlying assets' price movements. 3. Limited risk reduction. Volatility persistence. Although offering increased accessibility and convenience compared to directly owning ETH, it's crucial to remember that ETFs remain subject to the inherent volatility associated with the cryptocurrency market. This means that the value of the ETF shares can fluctuate significantly, potentially leading to substantial losses. Investors expecting complete risk mitigation by investing in ETFs instead of directly holding ETH might be disappointed, as the underlying volatility remains a significant factor. 4. Regulatory uncertainty. Evolving landscape. The regulatory landscape surrounding cryptocurrency remains in flux, and potential changes in regulations could impact ETFs and the broader cryptocurrency market. These regulatory changes could affect the structure, operation, and potential attractiveness of ETFs, potentially leading to unforeseen consequences for investors. 5. Counterparty risk. Custodian reliance. The security of the underlying ETH holdings relies heavily on the reputation and secure practices of the custodian employed by the ETF provider. Any potential breaches or security vulnerabilities at the custodian level could pose significant risks to the safety of the investor's assets. Question 6. How are Ethereum ETFs structured? There are two primary structures for ETFs, each with its own advantages and drawbacks. 1. Physical ETFs. Direct holding. These ETFs hold the underlying ETH tokens directly within their portfolio. This structure aims to offer the closest possible tracking of the price of ETH. Limited availability. Currently, due to regulatory hurdles and concerns from financial authorities, physical ETFs are not yet widely available in many jurisdictions, including the US. 2. Futures-based ETFs. Indirect exposure. These ETFs do not directly hold ETH tokens. Instead, they utilize futures contracts to gain exposure to the price of ETH. Greater availability. Futures-based ETFs are currently the more readily available option for investors seeking exposure to ETH through the ETF route. Additional complexities. Utilizing futures contracts introduces additional complexities compared to directly holding the underlying asset. These additional complexities can lead to tracking error, as futures contracts have different pricing dynamics compared to the underlying ETH. Tracking the price of ETH perfectly can be challenging. This can result in deviations in the performance of the ETF compared to the actual price movement of ETH. Roll costs. When futures contracts near expiry, they need to be rolled over to new contracts with longer maturities. This rolling process can incur additional costs that can further contribute to the tracking error. When choosing an ETF, it's crucial to understand its underlying structure. Physical ETFs offer a more direct exposure, but their availability is currently limited. Futures-based ETFs are readily available, but introduce additional complexities and potential tracking errors.